Good morning and welcome to Bloomberg, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's first go to the headlines and then we'll tackle the indices as they appear right now. First, the global news. North Korean leader Kim Jong-un arrives at Vietnam for a second summit with the US President Donald Trump beginning today. RBI floats a discussion paper on moving a large part of the bank CEO salaries to variable pay that would be adjusted with any divergence found in the lender's accounts. Fortis Healthcare moves SEBI seeking the arrest of former promoters Malvinder and Shivinder Singh after they failed to return 400 crores to the company within the stipulated time frame. And HPCL will make way for Britannia in the Nifty 50 effective March 29th. The big news first. The Pakistan Army claims Indian fighter jets violated Pakistani airspace in the Muzaffarabad sector. I think, frankly, if you look at the SGX Nifty intraday chart, you will see the impact, the small impact that this piece of news has had. Now, remember, this is unconfirmed news. Bloomberg News seem to be citing that. Global news headlines seem to be citing that. There's no confirmation at all. And therefore, we do not want to spread any kind of panic or any kind of misinformation surrounding this. All we are saying is that the markets are reacting to what has come in a couple of sections of media about a piece of news, about some bit of stress or tension around the border between India and Pakistan. As a result of that, the SGX Nifty, as we see, is corrected about 0.25%, 10,863 right now. The intraday would have shown that there is a bit of a fall that has come into SGX Nifty in the session today. But let's wait for more confirmations before we really delve into this in any fashion whatsoever. After the big up move that we've seen in the world markets by and large, today seems to be a bit of a dull day. Remember, both the Chinese markets and the US markets are up nearly 20% from the lows that they clocked in US markets in December, Chinese markets YTD. So right now, a sedate start, the sedate end for the US markets and a flattish start of sorts for almost all of the other Asian markets, but for Shanghai, which is building on the gains from where it left off yesterday. So 5.6% in trade yesterday, about 1% higher in trade, 2986 currently. But the point that I'm trying to make is both the Shanghai Composite as well as the US markets from the Christmas lows have gained almost 20%. So there's a bit of a stratospheric rise that has happened into both of these markets in the last 1.5 or 2 odd months. And therefore, if there are a few pauses, then those would only be warranted. Our markets too, the highest levels since February 11th for the Nifty, and the Nifty Bank showing its dominance really in trade yesterday after being lackluster for the last few days. However, I think the talking point today would be around how the market perceives the news flow surrounding, and the news flow will be very, very volatile. So for anybody who's a trader out there, I would urge to be very careful before you initiate any kind of trades on the Nifty or the Nifty Bank, simply because the news flow might be volatile, might be unconfirmed at times, but will still have a bearing on what the markets do. So remember, that will be the big talking point for the session today. What's happening, or if there is anything happening around the border in terms of stress, and should that have a bearing on trade realistically? So that is something that will be the talking point throughout the trading day today. But we'll wait for confirmed reports before we actually talk much more about this. For now, let's try and focus on stocks that will react irrespective of what happens around the border or doesn't happen around the border. Firstly, the Nifty rejig, and Britannia will replace HPCL effective March 29th. So both of those stocks could be in focus today. Eicher Motors is an interesting one. They've resumed the work in the Chennai facility. Remember, production of about 3,200 motorcycles got impacted as a result of the strike that was there. It had a bit of an overhang on Eicher Motors when the news first broke out. I don't know if this reverses a little bit of sentiment around Eicher Motors stock, which has gotten beaten down quite badly over the last few weeks. So let's wait and watch what happens to Eicher Motors today. DHFL, the problems don't seem to be going away. Aside of course, the divergence in the statements between the independent editor who stepped out and the company, commercial papers worth 8,000 crores have been downgraded by ICRA. So do watch out for this one in the session today. GVK Power and Canterbury Retail move to the short-term ASM framework. Let's see if there's a bit of an impact on both of these stocks. And sugar stocks seem to be hitting a bit of resistance. Pull up any of the sugar names, and on the RSI framework, they're all hitting levels of key resistance. So do watch out. After a stupendous rally the last few days, do Balrampur or Dhampur or any of the sugar names react slightly negatively today? That's something that we'll watch out for. However, let's tell you what's lined up on First Word today. It's the collection of the top editorial stories that we believe we should bring to you. Auto dealer survey for the month of February suggests there has been no pickup in sales. Yash Upadhyay will join us with the survey findings. Bata India is widening its lead in the footwear race. Agam Vakil will tell us how. Fortis warns its former promoters behind bars. Bloomberg's Ari will join us with the details of the petition. And then RBI has proposed tighter rules for bank CEO compensations. Ira Dugal will explain the regulator's rationale. Let's start off with autos. February is rarely a good month for automakers, and this year will be no different, suggests the Bloomberg Quince Auto Dealers survey. What makes it worse is the slowdown over the last few months. Yash Upadhyay, who does the survey, joins us now with the details. Yash, the discounts clearly don't seem to be doing the trick.
Absolutely, Neeraj. So I'll start with the survey, how many people that we've spoken to, which cities do they, come from. So we've actually spoken to 7 dealers across India, and we've tried to cover the entire geography. So starting from south in Cochin, Bangalore, all the way up in the north in Delhi, Lucknow, as well as Allahabad. So we've spoken to 7 dealers in most of these cities, like I mentioned. And what we are gathering is that February would not be a much better month when it comes to auto sales, primarily because of the fact that February tends to be a shorter month when it comes to sales because of the fewer number of days, as well as the fact that the demand sentiment this time around has been extremely weak. Dealers are finding it extremely difficult to convert potential buyers into actually buying the cars, despite of the discounts that we were mentioning, and we have seen a carry forward of these discounts into February as well. So that too has not managed to entice most of the buyers. As far as how the individual players are likely to perform, we'll start with Maruti Suzuki, the largest passenger car maker in the country, and that one is expected to see a 1.5% cut in volumes on a year-on-year basis, a marginal downtick, but still another month of downtick there. Mahindra and Bajaj Auto would be the 2 key names to watch out for, as they had an unusually slow February of last year. So on the back of that, there could be some improvement seen for both Mahindra and Bajaj Auto, about 7.5% and 9% for Bajaj Auto. Tata Motors, again, they had sales of more than 63,000 units in the February of last year, so they are expected to do extremely bad because of the high base effect coming into place, a 9% drop. Hero MotoCorp, TVS, as well as Royal Enfield, again, all of them expected to do far worse. A 4.5% cut, or almost close to 5% when it comes to Hero MotoCorp, a 5% for TVS as well, and Royal Enfield, a 1% fall in volumes. That number could be much higher as well because of the the strike at one of its facilities. But let's also take a look at which are the top selling models and how are things panning out. For Maruti Suzuki, they have been giving in huge discounts of more than 1 lakh rupees for some of its models, 40,000 rupees discount along with exchange when it comes to their top selling models like the Baleno, Brezza, as well as the 2018 Desire. In terms of what's pulling in the volumes, it is the newly launched vehicles that are doing really very well. The Ertiga and the Wagoner, they both command waiting periods of close to 3 months. Certain models, in fact, for Ertiga having a waiting period of more than 3 months. Moving forward, when it comes to Mahindra and Mahindra, again, it is the heavy discounting that is working in favor for the company, but they compared to the other players have had more number of recent launches, and that is the reason why that is one of the reasons why they could do better. In terms of the offers that they have, Scorpio XUV 500 having cash discounts of more than 50,000 rupees, and moving forward in terms of the waiting period, well, the recently launched XUV 300 has already crossed advance bookings of more than 4,000 units with its launch last month. Moving forward, when it comes to Tata Motors, again, the dealers have been giving out huge discounts, and these are from the dealers itself and not supported by the OEMs at all in this period. And again, the waiting periods being as high as 3 months when it comes to Harrier, and some huge discounts when it comes to their top selling models like the Nexon as well as Hexa, where the cash discounts span all the way up to 75,000 and 1 lakh rupees. Moving forward to the two-wheeler space, not a whole lot of discounting when it comes to Royal Enfield, but for the entry level or the commuter segment bikes, which is the sub 125cc, the cash discounts go up to 2,500 rupees, and for the high-end premium bikes, it goes up to 5,000 for most of these players.
Thanks a lot for that, Yash. On to the more important news. Pakistani army spokespersons have claimed that Indian fighter jets entered the Pakistani airspace before retreating. The spokesperson took to Twitter claiming that the Pakistani Air Force scrambled, forcing the jets to fly back into Indian airspace near Balakot. Indian authorities are yet to officially confirm any such move. Please remember, we do not have any confirmations about this move, but it's important to talk about this, and who better than Sanjay Pugalia, editorial director at Quintillion Media, who joins us right now on the phone line for more. Sanjay, good morning. Thanks so much for joining in. What is it that you are gathering? Is the situation indeed very tense, or more tense than what was the situation yesterday at the border?
Yeah, definitely so. And as you rightly said, that Pakistani side via Twitter has informed that some action has taken place in Pak-occupied Jammu and Kashmir area near Bagalkot. So we do not have any details. What we hear from those journalists who are covering defense and strategic affairs, that government of India soon may be sharing some information. But this is clearly a airstrike, not a surgical strike in the sense that people have not gone on the ground. Our planes have gone there and conducted some exercise there. What is the extent of damage, we do not know, but clearly it seems that in POK side, some terrorist camps or some establishments might have been targeted.
Interesting. Sanjay, so you are saying that the news that we had as of now was that Indian air jets violated the space and retreated. You are saying that you are hearing from people or journalists who are covering this field that there could have been some strikes that could also have been done.
Sorry, I couldn't hear you again.
No, Sanjay, I'm asking you if the news that we had as of now was that the Indian Air Force jets went into the airspace, or at least the Pakistani army seems to be claiming that Indian Air Force jets went into the airspace and retreated. What you're saying is that journalists are telling you that there might have been some strikes as well?
No, if you read Pakistani version, they talk about releasing some payload and no casualty. So I'm going by that.
Okay.
That there might have been some action. Clearly, Indian side is giving a warning. It might have been a very limited exercise, but yeah, temperature is rising. Government of India has been very clear on this, that some action will be taken. So there is a serious anticipation all over that what action could that be. If you remember, US President Trump did say 2 days ago that India is planning something very serious and strong. So if you put these statements together, in coming days, we will see some action. That is the current perception here in Delhi.
Sanjay, my one last question, because I know it's very early morning for you, but I'm guessing you wouldn't be surprised if we did indeed have a situation of a strike, if not now, then in the next few days.
Look, they are working at multiple levels. One of them is very serious diplomatic pressure on Pakistan to show some verifiable, demonstrable action. If that happens and that addresses India's concern, that will be one way to look at it. Second is direct military action, and we have seen first glimpse of it. So anticipation is building that India may be opting for the option number 2, but we will have to closely wait and watch. But very clearly this morning something has happened. Pakistani side has first informed us, and what we hear that Indian side will be telling us something. So yeah, it is a beginning of a bit long process.
Okay, we wouldn't want to put words in your mouth, neither we want to misinform viewers, so let's leave it at that. Sanjay Pugalia, thank you so much for clarifying what the situation at hand stands right now. Really appreciate your time.
Thank you.
That's Sanjay Pugalia of Quintillion Media. Ajay Srivastava of Dimensions Consulting, who looks at politics and markets very, very closely, joins us right now for a quick perspective as well. Ajay, as of now, no confirmations, but we just try and address what the Pakistani side has been telling us. What do you make of this? The SGX Nifty is clearly showing that it is worried.
Of course, this is going on expected lines. I think the market was very clear that this is going to happen. We rode a global rally on top of this uncertainty, but the domestic investor clearly was on the selling side. And I think this doesn't add up anything good for the market. No matter how necessary it is for the country to respond to a very dastardly attack, that's all fine. But as a market participant is concerned, this is not good for us because it's coming at a time when we were just about getting into the emerging market rally, and it will just stall us for the day at this point of time. Depends. Let's see how the escalation goes. Let's see what response goes. Pakistan, I'm sure, was expecting some Indian response in an election year. Had to happen. Would have definitely been on the cards. So I think market was apprehending it. It was being nervous about it. Now the event has happened. There will be some morning selling happening. But I think a lot more to say as to what the response of the government is going to be in a post-press conference, whether it's going to be escalation or now that the retaliation has been done, at least the optics of the whole issue have been taken care of from the Indian perspective in an election year as well. So I think it all depends upon how the government responds at the end of the day. But I think definitely you will see at every rally, if we ever catch the emerging market rally again, you will see more domestic selling coming through.
Okay, Ajay, so one, the sentimental reaction, because as of now, as things stand from the information that we have at hand, it's a sentimental reaction. There is no response that has come in from the Indian authorities. So we do not take the Pakistani authorities or the Pakistani side version as gospel, but that has had a sentimental impact. My question is, if indeed there is some confirmation about such an action from the Indian side, what's the impact on markets do you envisage?
Well, definitely the Indian side has so far not said anything in response to the Pakistani tweets. Obviously, all indications are that something did happen in this episode. So, our reaction is going to be very simple. People have been selling the rally yesterday. People will, at this point of time, morning, the market will open lower, so you won't get a chance to sell too much in the morning. And I think by and large, people will hold on some major selling. You might find some stocks which could have direct impact from this kind of a bombing rate, things like Reliance, etc., responding much more. You'll find rupee reacting. Luckily, oil has been on the lower side, so to that extent, we have a muted response on rupee, but rupee will go down. The interest rates are going to go up. So all these things will happen in the morning. But my belief is that Indian domestic investor at least will not sell in the morning too much because, one, there will be a gap down opening. Second, some selling happened last 2-3 days with a good rally. So they will hold off and see where this goes. On the market lows, I don't think you'll see too much of selling. Yes, you're pairing of future positions. Of course, normally with the margin calls will happen, which is the normal course of it will happen. But I think people are going to wait to see the response and then react. But definitely the reaction is not only this episode. The economic issue is also playing on the domestic investor's mind. So he's in a selling mode. As soon as they reach the break-even level or a little bit of profit, domestic investor is selling at this point of time. And logically, I think you'll find FIs not being buying today in the post-lunch session. So I think that bit of cushion is gone, what we got yesterday. So market is going to be lower. It's going to be nervous. Let's see how the government responds. I think there'll be a lot of maturity there because it's not an emotional issue. I think a lot of financial economic ramifications of what's going around.
Okay, Ajay, let's leave it at that. Thank you so much for taking the time out. Really appreciate your time, Ajay.
You're welcome.
I think that's good analysis of what could happen if indeed we have confirmations. I repeat, for the benefit of all the viewers who are tuned in right now, we do not have any confirmations from the Indian authorities side about what has happened. All that the markets or the SGX Nifty is reacting to right now are claims made from the Pakistani side. Having said that, yes, there is a sharp fall and we will be monitoring this. There could be impact on the Indian bond markets as well, something that we'll monitor. So keep that at the back of your mind. As and when we get more details, we will get you some confirmations. Maybe the Indian government decides to speak in some minutes, in which case we'll cut to that as well. Moving on to other stories, the RBI has proposed further tightening of the rules for compensation paid to bank CEOs if implemented. In its current form, bank CEOs will see a larger portion of their salary come in form of variable pay, and the variable component will be subject to penalties for any divergence between the bad loan assessment of the bank and the regulator. Ira Duggal joins us now on the phone line for more on this. Ira, one way of making the bank's top management more accountable, I'd say.
100%, and that is, Neeraj, the context in which these guidelines have come. They were last reviewed about 6 years back. They were still a lot more liberal than what we have seen globally. So this is the second step of tightening. Briefly, what they have done is that they have said that at least 50% of CEO and whole-time directors' compensation should be variable. Earlier, they had said a substantial portion should be variable, but they hadn't put a threshold to it. Now they're saying 50% of the pay should come in a variable form. 50% of that variable should be a non-cash component. Earlier, there was no specific proportion that had been prescribed. Both of these obviously linked to the fact that you want more of a bank CEO, whole-time director's performance to be linked to the bank's performance. They go on to say that employee stock options will be a component of variable pay. I assume this will be a big change because till now these stock options were kept outside variable pay, and variable pay was capped at 70% of fixed pay. So now they're saying variable pay can only be up to 200% of the fixed pay, which looks like a jump, but that includes ESOPs. So I would assume that that would mean a fair amount of restructuring for a lot of bank CEOs. I think the biggest, to me, important part is the fact that they have said that there has to be a link between the asset quality performance of the bank and the compensation that is paid out, the variable compensation at least. So they proposed a way to impose penalties in case of a divergence in NPA and provisioning beyond the RBI's prescribed threshold. In that kind of a scenario, they've told the banks that you have to put a modality in place to claw back some of the variable pay that has not been paid out for that particular year, and you also cannot consider an increase in variable pay for the next year. So very, essentially, apart from other smaller provisions, the message going out to bank CEOs and to whole-time directors is very clear. We do not want to encourage excessive risk-taking in banks. We want your performance to be linked to the bank's performance. And we want that performance to be linked not just to stock performance or profit performance, but to asset quality performance and the regulatory meeting of guidelines, which to the regulator is far more important than just ROE or ROA for the bank.
Better late than never. I'm sure you are heartened by this news. You're gladdened by this piece of development, I'm guessing.
I certainly am, Neeraj. I think this was much required, sort of crackdown on private banks, which are supposed to be done better than public sector banks. But, well, the previous cycle has shown that it's not necessarily true.
Okay. I'm sure a larger discussion on this will happen on lunch as well. So we'll look forward to that. Ida, thanks so much for joining in early morning and talking about that. Okay. The next piece on First Word. Fortis Healthcare wants its former promoters behind bars. The new promoters may have written, or actually have written, to the market regulator after Malvinder and Shivinder Singh failed to repay about 400 crores in the company. Bloomberg News reports.
The former billionaire Singh Brothers are now threatened with arrest in the latest development in the former tycoon's long fall from grace. The latest is that Fortis Healthcare, the company they founded and once controlled, has asked India's stock market regulator to use its powers to enforce the collection of the 4 billion rupees the Singhs are accused from taking from the company. Those powers could possibly include arrest. The stock market regulator found that the Singhs had defrauded Fortis of about 4 billion rupees in October and given them 3 months to repay the money. But that time came and went, and they still haven't got the money back, so Fortis has asked the stock market regulator to get it back for them. I'm Ari Alstetter for Bloomberg News in Mumbai.
Ari, thanks so much for getting us that piece of update. Now, just a development going back to the big story this morning. The Indian Defence Ministry spokesperson has told Bloomberg News that there is no information of the airstrike in Pakistan. And I think that is important. This is a moving piece. I repeat, developments will happen in a jiffy. It will be very difficult to trade this. But as we learn, the Indian Defence Ministry is saying that there is no information of an airstrike. So you take that at face value. There's a bit of to and fro, but no information of an airstrike, most importantly. It doesn't mean that there might not have been some patrolling done at the border, etc., but there's no information of airstrike, so let's just leave it at that. The last piece on First Word today, Bata India surged 80% over the past year to become one of the top 3 gainers on the Nifty 500. But what's helping the footwear maker stay ahead in the race? Agam Vakili is standing by to tell us just that. Agam, good morning.
Good morning, Neeraj. Well, I'm going to quickly start by taking a look at how Bata has done against the NSE 500 over the last 12 months. As you can see, while Bata has gained as much as 80% and it's clearly outperformed the index, which has actually given us a decline of around 4% in that same period. Now, what are these factors that are aiding Bata? Firstly, of course, there's this rejig right at the top. At a global level, we have Alexis Nasser, who took over the reins in 2016. Even in the Indian arena, we have Sandeep Kataria, who was appointed CEO in November of 2017. And let's not forget, one name which has been attached to Bata since 1986 is Ramkumar Gupta, and he rejoined the company after leaving Bata in 2015. So, this team has actually gone ahead and made a lot of changes. And speaking of changes, let's talk about what Bata has done over the previous few years, I would say. What they have done is that they have now moved when diversified across various segments, that is in premium, mid-premium and mass. Right at the top of perhaps the last 3 years, what we essentially saw was Bata dominate the mass segment and perhaps to a certain extent the mid-premium segment. But now, with the entrance of Hush Puppies, Ambassador and Dr. Scholl's, we've seen that entrance into, that arena. But let's move on and talk about your other factors as well and pull up some other slides, moving on. Of course, as I was suggesting, that they have also, ventured into several other arenas. But let's talk about some of those. Okay, so this is where your price-wise breakup is for Bata. And as you can see, about 30%, only 30% over 1,500 rupees per pair is where you get your revenues from. A whole host of other price points is where Bata is well diversified, and that is the other point that I was trying to make. So there has certainly been a lot of changes coming through in terms of product ranges and premiumization. And let's not forget, at this point in time, they're also looking at a lot of advertising. So higher advertising and promotion outlay. They've gone and appointed several brand ambassadors, and of course they're focusing on youth at this point in time, and also on sub-brands improving perception. And these are some of the areas where we are seeing Bata improve substantially. So we are keeping an eye on all these developments, but these are essentially the reasons which has actually driven Bata going forward, at least in the last 1 year.
Okay, Agaman, so all of this is translating into better financial, I guess, for Bata.
Yes, absolutely. It's very evident in the earnings too. And I'm going to talk about their revenue growth. So over FY17 through 20, we're expecting about 11 to 12% CAGR as far as revenues are concerned. But look at the margins expansion. Based on their premiumization play, as per Edelweiss, they're expecting margins to expand to as much as 17%. They've already moved up to as much as in double digits. And they're expected to expand considerably. So this, of course, will be a positive. Gross margins is another very critical factor here. As you can see, gross margins firstly has grown for 7 straight quarters on a year-on-year basis, currently at 58.6%, at the highest that we've seen in the last 3 years. And because of controlled rental costs, of course, that's on account of the other margins, not necessarily just gross margins, but we also have operating leverage and GST benefits playing in favor of your EBITDA levels. And but that said, it is still a very expensive stock, so currently at 57 times, well ahead of this average of around 45 times, and also much more expensive than Relaxo Footwear, Liberty Shoes, and Khadim. So there is a reason behind which it's currently trading at a premium, and this is, of course, your analyst ratings, where 9 analysts still have a buy rating, and that contributes to about, as much as 80% of, the return potential at this point in time, because Bata has run up so much, is a negative 5.5%. But all in all, analysts still remain positive, despite the fact that it currently trades at very, very rich valuations.
Thanks for putting that into perspective. Appreciate that. As we speak, just before we wrap it up, pull up the SGX Nifty intraday, and that succumbed to some more selling pressure. It's now trading in and around the lowest point of the day, 100 odd points. So never mind what's happening to the rest of the world. By the way, I must say, Shanghai too, very interesting to see that if you're talking about what's happening to world markets, Shanghai is now in the red. I remember when we started the show, the Shanghai markets were up almost 0.75%. From there, it's now down about 0.5%. So all of the Asian markets too seem to be reacting to this piece of news. Hang Seng down about 0.7%. Not this piece of news, this piece of to and fro from news sources. Let me qualify my statement. But Shanghai 2 in the red, the SGX Nifty trading at the lowest point of the day. Suffice to say, we'll have a start which is in the red. The question mark only is what can happen during the course of the day. We'll try and get a lot of experts really to talk about this. For now, we need to slip into a break. This is all that we have on First Word. Lots more lined up for you on Indian Open. We speak to Chalet Hotels, Sanjay, Sethi about plans underway post-IPO and discuss business outlook for United Breweries with Managing Director Shekhar Ramamurthy. But after this break, a full tilt towards the day's trade. Stay tuned to Bloomberg Live.
Fulfill your dreams of buying a new house, new car, or achieving academic success. Attractive interest rates and easy processing. The trust, commitment, and excellence since 1937. Indian Overseas Bank, good people to grow with.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
And welcome. You're watching Indian Open right here on Bloomberg Quint Live, and it looks like today's market is going to be a little bit off or a tougher watch.
Yeah, it seems to be. I mean, the flashes on your screen and clearly sources telling ANI that there's some payload that was dropped in terrorist camps across the LOC, but we're still waiting for official confirmation. I think. So while there will be a reaction and negative reaction, all in that, and SGX Nifty meanwhile is showing some signs of an uptick as well, but it's best to probably react, at least as journalists, to official confirmations that come in. But having said that, we have to bring all the information that comes to us. So this information on your screen from ANI, but also sources to ANI saying this. There's no confirmation, Devina, as yet that we have from the Indian Defense Ministry or the Indian government. All that the markets are reacting to worldwide
they've denied it.
Is to what's happening through Pakistan side. So we're still waiting any kind of denial or acceptance from the Indian authorities side with regards to this. I think the Bloomberg News reported that the Indian Defense Ministry said there is no information of an airstrike.
Right.
But that is also on Bloomberg News, quoting Indian Defense Ministry sources. So, well, let's wait and watch.
Just to address those flashes nonetheless, while the source is saying that at 3:30 hours on 26th of February, a group of Mirage 2000 Indian fighter jets struck major terrorist camp across the LOC and completely destroyed it. These are just ANI sources saying this. So, you're going to be very careful of what you actually react to, what kind of news you actually react to.
Yeah, you could get whipsawed either direction, Devina, in a time like this, because confirmations or denials would have a big bearing on what the markets do. For now, about 1/3 of a percent or 2/3 of a percent in the red.
And you may likely continuously see to and fro what's happening today.
100%.
A lot of news floating around. You'll have to be slightly more guarded in terms of what you do with markets today.
Yeah. I mean, that's really the sum and substance of it all.
All right, so let's move on from that and tell you what it looks like for the derivative space this morning, and the setup from yesterday. Agam Bakil is standing by. Agam, it was a good day yesterday. What was the setup like?
Well, it certainly was a good day yesterday, and we did see gains coming through for the fourth straight day with, some, decline in open interest, but this is as far as the February futures goes. Of course, it is expiry, so we're likely to see a decline in open interest for the February futures. The same for the Nifty banking futures, down by as much as 3.3%. The WIX, however, has remained stable. There is a likelihood that it could move up should we see some amount of updates from the Indian authorities on what has been reported out there with respect to the LOC. But the open interest currently, in terms of change, well, written around 10,800. And in terms of your Nifty put call ratio, okay, this is, of course, is your open interest distribution, but let's talk about the Nifty put call ratio, and that's like is higher at around 1.546. Bank Nifty put call ratio also higher at around 1.4. In terms of stocks which are in the F&O ban, Advani Enterprises Power and Allahabad Bank. Among others, we have IDBI Bank, Jet Airways, and Reliance Power. One stock that moves out of the F&O ban is PC Jewelers, so keep an eye on that one as well. In terms of other stocks we're keeping an eye on is Adani Ports and DCB Bank, which did see substantial movement, along with Bharti Infratel. And on the losing end, in terms of drop in open interest, Piramal Enterprises, something that stands out along with Torrent Power. So again, watch out for these. We've had mixed cues, but the real question is, can we expect some volatility, at least as far as the opening is concerned, and what that can do to these stocks even as we move to expiry. So that's a wait and watch.
All right, Agam, thanks very much for that. That's a quick F&O setup that we have this morning, but lots to discuss. So we've got a lot of stocks to keep an eye out on as to what's going to make its move. On either side, some brokerages giving their calls this morning. Our research team is going to be ready with us in just a few moments, but that's what you've got, slightly more downward bias on the SGX Nifty.
Yeah. There are two or three things. One is to separate the wheat from the chaff. So we'll probably have some bit of moves happening on specific stocks in line with what the news flow is. Also got to keep in mind some stocks that have or will react on the basis of news developments that have happened yesterday. It was turning out to be a day of news flow which wasn't the strongest, but now we do have, post 6 p.m. yesterday, serious amount of news flow. One, the Nifty rejig happening from March 29. So Britannia coming in and HPCL going out. So that's the first piece of news that will happen on specific stocks. So you got to monitor that. Two, a lot of resistance that the sugar counters seem to have run into. The RSI is heavily overbought. Big moves yesterday as well after the kind of moves that we've seen already. So does the market also give a reason for them to correct? And then crude has corrected seriously, 3% down yesterday. Let's see the impact that it has on some of the oil marketing companies in the session today. So 2 or 3 things from a news flow perspective that we have to monitor, in addition to, of course, all of this.
Yeah, HPCL and Britannia and all of these stocks were up. Sugar stocks that you mentioned were up about 12 to 15% in yesterday's session. So it's an interesting play to see whether or not you do see some profit taking, but that's not happened since the last 1 month since they've actually started moving up. So that being one. But let's go to the research huddle now, and all of them here with us to take us through some stocks in news as well as some brokerage calls that are coming in. So Mishika as well as Amit, both of them are here with us. Mishika, let's run through the stocks in news first.
Yeah. Let's look at the stocks that have been focused today. Eicher Motors says that the entire workforce is reported to work at their Chennai facility with effect from February 23rd, resulting in resumption of regular manufacturing activities. And the estimated impact of this strike was production of approximately 3,200 motorcycles. ICRA downgrades DHFL's commercial papers worth rupees 8,000 crores to A2 plus from A1 plus, to which the company says that the rating action by ICRA is not on merit based at all. It has not taken cognizance of DHFL's intent to extinguish CPs by end of March, and the fact that it is in advanced stages of fundraising transactions. And Jet Airways clarifies that it is in talks with stakeholders to ensure that the company becomes current on its salary dues. The airline company also clarified that news of SBI mulling insolvency via NCLT to recover loan is speculative in nature. Then Adani Enterprises clarifies on the news of its defense arm winning a contract worth $2 billion that there is no such development as of now. And it's the highest bidder to operate 5 Indian airports. The company's bids were higher than GMR, NIIF Zurich Airport, reports Airports Authority of India. Then SEBI imposed penalty of ₹1 crore on ADF Foods promoter Bhavesh Thakkar and Priyanka Thakkar and 4 others in an insider trading case. Then we have the board of Bliss GVS Pharma approves to increase FPI limit from 24% to 74% in the company. Now let's look at the replacement in Index Nifty 50, which will come into effect from March 29th. Britannia Industries replaces Hindustan Petroleum Corporation.
All right, Mishika, thanks very much for that. So all these stocks will be watched out for. What about some brokerage calls, Amit?
Well, a couple of them. First one is on IFL Holding, where Credit Suisse has maintained its underperform rating on the stock but has cut down the target price to 315 from 400 rupees. Now, according to the brokerage, change in business model and regulatory issues would weigh on the company going forward. Now, the brokerage is expecting IFL's wealth management yield to remain volatile in the coming quarters as the company is transforming its customers into the advisory model of IFL One and IFL All-In. Now, along with this, adverse regulatory news flow would be an overhang on the stock, says the brokerage. Lastly, with slower growth estimates in lending and a weaker near-term profitability in the wealth business, the brokerage has cut its EPS estimates for IFL Holding by nearly 25%. Second, we have is Goldman Sachs on Reliance Industries. Now, the brokerage has maintained its buy rating on the stock and has hiked the target price on Reliance Industries to close to 1,455 rupees from 1,380. Now, according to the brokerage, the retail business of Reliance Industries is becoming one of the key earnings growth pillar, and going forward it sees a significant growth potential on the back of market share gains for the retail business. Now, the brokerage has assigned an enterprise value of close to $30 billion, that is more than 2.1 lakh crore rupees to the retail business, as it is expecting the retail business revenue and EBITDA to grow at a compounded annual growth rate of 16% and 19% over the next 10 years. Now, to capture this high retail value, the brokerage has hiked the target price for Reliance Industries to close to 1,455 rupees.
Okay, thanks a lot for that, both of you. Let's take it to our experts. We'll get in technical experts in a bit to talk about how to trade the index in a scenario like this, wherein the SGX Nifty is indicating that we'll have a start which is in the red. By the way, I must also add that the Shanghai markets have recovered a little bit. So they too turned volatile on, I'm presuming, this news flow, quote unquote news flow, but as of now the Shanghai markets are trading absolutely flat, so very, very choppy trades in the Chinese markets too. But the SGX Nifty clearly down and staying low, maybe a brief bit of a bounce from those 0.9% off to about 0.6, but currently again about 10,800 odd is what this is showing. Mayuresh Joshi, fund manager at Angel Broking, joins us right now on the show. Mayuresh, until clarity emerges around this, all bets off?
Morning, Neeraj. Oh, it seems to be the case, Neeraj. So I think, yes, you should bide your time. I think just let the news flow settle down.
Yeah. Having said that, Mayuresh, what's the sense that you guys at Angel are having in your morning meetings, etc.? What are the levels that you guys envisage the index could slink to if indeed the news flow on this turns out to be true? Or would it be a short-lived event if the extent of the move or the extent of the move that's happened, if it has happened, would only be restricted to this?
So very difficult to gauge. But again, I think if you go by the historical instances that have happened in the past, my own sense is that if it is not of a serious implication, which we'll come to know over the next few hours, I think the markets should recover whatever they might lose or whatever they are indicating. Having said that, I think the kind of trajectory that the overall index has been gyrating into over the past few weeks, I think that volatility might very well continue. I think you've got a plethora of factors at play. And again, I think the earnings have not been great even for this quarter. So largely, I think the premise is that it is going to be very, very volatile over the next few weeks, at least up till elections. In this volatility, again, I think the quality stocks have corrected. So I think you probably need to look out for these qualitative names. But I think you've got plenty of time on your side. So I think you probably do not need to rush into markets like these. You will get your opportunities to probably identify the stocks and sectors and enter them in a very staggered manner over the next few weeks.
Right. Mayuresh, let's come down to specific stocks now. And the big change on the index, HPCL moving out, Britannia moving in. When you talk about quality stocks, Britannia has been strong name within the FMCG basket. Is there likely to be more interest now in the counter?
Morning, Devina. Oh, definitely a good day for Britannia, if I may put it that way. So in that sense, again, I think the kind of numbers that have held up for Britannia compared to its peers within the FMCG pack, I think they have been exemplary. Secondly, I think the premiumization in terms of its biscuits portfolio have clearly held out for them. And again, I think the under-penetration in key markets where a competitor like Parla has gained significant foothold over the past few decades, I think they're trying to probably get inroads into states like Uttar Pradesh, Rajasthan, Madhya Pradesh, even northern parts of Gujarat. So as their direct distribution reach starts improving in these states, and as their market share probably starts getting better, I think the traction that one probably assumes, both in terms of volumes and because of the premiumization effect, the volume-led price action is clearly going to create the leverage on their balance sheet. The third element obviously has been their cost optimization program, which has clearly yielded definite and positive results over the past few years. And they do expect a reasonable amount of savings to come through for the next financial year as well. The fourth element obviously that needs to be watched out is the input costs and how a lot of the moving parts specifically that affects directly the gross margins and whether they'll be able to pass it through in terms of price hikes need to be observed. But there is some amount of stability that is probably being seen in input costs, which means that the margins should probably remain stable as well. The only element that probably works against Britannia is valuations. But again, I think the premium justification that one probably gives this stock and what the stock probably derives its underlying for in terms of strong growth that can come through, I think the premium valuations probably can get justified. Again, I think with the inclusion, we're probably going to see more flows come through and the adjustment will keep the stock afloat. So anybody holding on should clearly hold it.
Yeah, the Nifty funds will be adjusting for Britannia, and that will see quite a sizable sum of money coming into Britannia. So watch out for that one. The other pocket, Mayuresh, is the sugar space, which has been extremely buoyant in the last 1 month. And in fact, you're not seeing any sort of profit taking either. So it looks more structural in nature in terms of the kind of move that the entire pocket has seen. Does it encourage you to have a relook at this pocket?
So Devin, again, I think some facts here which probably might play out for the sector as a whole. If you're probably talking about the sugar season and what ISMA productions are hinting, you're probably looking at 30 million tons this year. Now the demand is expected to hold up to around 26 million tons odd. So you've already got an excess even with a lower production of almost 3 to 4 million tons for this sugar season, and crushing has begun very, very early this time round. Now, if you look at the carryover inventory that has come over from last sugar season, that's almost 8 to 9 million tons, which probably means that even if you adjust for the mandatory exports of 5 million tons, which in my opinion have not fully been covered at this point of time, you're still going to have a reasonable amount of carryover inventory getting into the next sugar season. Now, when you're probably talking about the price hikes that have probably taken place by 2 rupees that the government has mandated, I think it's a very positive sign for the sector as a whole. But you need to probably look in the pretext and context of the cost of production for key sugar producing states, which is Uttar Pradesh and Maharashtra, which is still at par. So I think you're probably going to reduce the kind of hit that these sugar companies were making in terms of their operating performances. But then there is the sugarcane arrears that one also needs to take care of. That's almost 20,000 crores that needs to get paid off. Yes, you've seen some amount of improvement in terms of the EBITDA margin profile. And with this perspective in terms of wholesale prices moving up, I think the integrated players and along with the price hikes and the realizations from ethanol and companies which are probably having distillery operations along with the blended ethanol operations, they clearly stand to benefit because the PBT probably improves for a lot of these sugar companies. Having said that, I think the sugar cycle is a 2.5 year on-off cycle. The next year in terms of how the patterns move and as the production patterns can come down even further might be a positive sign for the industry as a whole. But I think a lot of preemptive moves have probably happened in stocks. So I think DCM Shriram is something that we continue to hold in our portfolios. It's a mix of sugar, caustic soda, where I think the prices are coming back as well.
Okay, Mayuresh, stay on. So much more to talk about. Let's get in our technical experts on board. Amit Harchekar at least is with us, so let's start off a conversation with him. He's Director at Index Genius Investment Advisors. Amit, good morning. Thanks for joining in. How are you approaching trade today, Amit? We are likely to start off anywhere between 1% to 0.5% lower because the SGX Nifty is very volatile. Would you initiate any fresh trades on open?
Well, I would be going long on this market even if there's a decline of around 100 points. Basically, if you see the broader end of the market, we are seeing a significant recovery. And most importantly, this recovery has been leading by the sector like commodities, which were trading at around 52-week low. So we don't expect this market to sustain at lower levels. In fact, on the derivative angle, if you see the FI's buying price in Nifty futures, that stands around 10,750, 760. So we expect markets to stabilize over these levels. So from a very short-term trading perspective, 10,750 should be a stop loss on a closing basis, and we are expecting again markets to move higher and even cross 11,000 in coming days.
Yeah, interesting. So Amit Harchekar wanting to buy into the fall. Let's wait and watch if the markets give that opportunity, and then more importantly, while the charts may show positivity, if indeed the sentiment might take the index slightly lower, but he's placing a firm stop loss at about 10,750. Okay, we'll get into stocks as well. Maybe we should also try and get what the Bloomberg Edge is saying, but while we wait for that, Amit Harchekar, what about your stock-specific recommendations?
Well, as I was saying, we are expecting a broad-based recovery, and first stock we would recommend would be buying ITC futures at around above 140, and we are expecting it to move towards about 278, and we are expecting it to move toward 294. The rationale behind buying ITC would be, if you see the Bharat 22 ETF index, that has seen a formation of a falling wedge pattern, and now that index is expected to rally by 15%. Remember, this was the index which dragged Nifty lower towards the 10,500, 10,600 levels, and if this index has to move up by 10%, which should be led by ITC, we can even expect Nifty to move beyond 11,000 levels. So ITC would be my first pick, and second would be buying NTPC futures. Here the levels would be buying futures with a stop of 135. We are expecting it to move towards 150. Now the rationale behind NTC is we are seeing similar falling wedge pattern even in Nifty Public Sector Enterprise Index. So that index has already confirmed a significant bottom in the near term, and this index is marginally around 0.5% away from the actual breakout of this falling wedge. The moment the breakout occurs, we can expect a rally of at least 10%. So both this index, Bharat 22 index, as well as Nifty Public Sector Enterprises Index, would ensure that Nifty may not sustain at lower levels for beyond more than 2 days.
Okay, Amit, sorry, we'll have to just come back to you in moments from now, because the NDF markets have reacted already on this news flow, if I can call it that. Bhaskar Panda, Treasury Advisory Group at HDFC Bank, joins us right now on the phone line for his quick perspective. Bhaskar, good having you. Thanks for joining in. What's your sense on what happens to the money markets today?
I think the news is still not confirmed as far as I know. So obviously this news will have an impact when the dollar rupee opens. NDF is already showing strength. I hope, it is not too much volatility today, but I think its rupee opening will be with a gap, probably around 71.30 or something. And obviously, central bank also will be watching the markets. So therefore, there is a palpable tension in the dealing room, but I think as the day progresses, we could see it, dissipating.
Yesterday's close was 70.98 on the currency, which was slightly more stronger. The NDF market suggesting a dip of about 0.5%. So like Bhaskar said, about 71.3, 71.4 is where you could expect the currency to open up. For the bond market yields, which increased from 7.36 a week or so ago to 7.41 now, what's the outlook and where do you expect it to settle?
See, yesterday was quite, dull market in the bond market. But today, obviously, this news will affect both bond as well as rupee markets. Rupee markets more than the bond markets. So probably there will be a little more rally in the yields. So maybe another 5-10 basis points. I don't know exactly what, market could react to. So I'm hoping, or I'm guessing that it will be, 5-10 basis points move in the morning itself, and after that it could settle down to the news flows. as it comes. But if it escalates, then there is an issue that we'll have to look to future.
All right. Thanks a lot for that. Quick comments from Bhaskar Panda at HDFC Bank. So can expect an initial knee-jerk reaction in the currency market more than the bond market. So while you will see, probably a 5-10 basis point according to Bhaskar Panda, the yields coming higher than 7.41 that it closed at yesterday. The currency is something that you need to watch out for, and the rupee particularly 71.3, 71.4 is the likely start for the rupee as well. Let's go back to our conversation with both our guests. We've got Amit Harchekar as well as Mayuresh Joshi. Mayuresh, yesterday's session saw Adani Ports crumble in trade, about 9% under for Adani Ports, because of the news flow. And that's the only stock within the Adani group that got affected, not even Adani Enterprises, even though it is a party to the news. What's your sense now on the stock at around 324?
You should let it clearly settle down, because I think with what had transpired yesterday, and again the presumptions in terms of how much it can get added, the acquisition to the top line and the EBITDA for ports and the group as well, I think one really needs to take that into stride. The second element obviously is the value that you're probably paying for this acquisition, and what kind of an impact does that have on the cash flows, because one really needs to make the adjustment in terms of the EBITDA accretion and what you're probably paying out and how that affects your cash flows. The third element obviously is their core business. So I think the core business, both in terms of container volume growth and the expectations of how the SEZ development will probably take place, does hold accretive value to the stock as a whole. So my opinion is, I think you should probably wait for a few more days, let it settle down. Let us probably understand what kind of an impact will it have financially. And again, I think if the cash flows do get affected, I think the stock is then probably stuck in a very broad range. So I think let it settle down is what I feel.
Okay, on to a special segment, Bloomberg Edge, with a bit of a delay, albeit of course, where Yash Upadhyay brings about a pattern that the Bloomberg terminal is thrown up on a stock while we're talking about trading ideas. Yash, what is the terminal suggesting?
Good morning, Neeraj. So the terminal suggests a buy call when it comes to Kansai Nerolac, and the indicator again is the proprietary Bloomberg indicator, which is the tender indicator. Before we start, let's try and understand what the indicator is and how do you interpret it. It basically uses the average true range for the purpose of calculation, and it also helps you manage your stop loss. How do you interpret it? You go long when the trend line changes its color from red to green, and you go short when it changes its color from green to red. In the case of Kansai Nerolac in particular, we've seen that after gaining for the last two trading sessions on the back of very heavy volumes, the trend line, which is the one in red over here, that is likely to flip its color as the stock has managed to close above the mark. So the red line is at the mark of 452. The stock closed at 455 on Monday, and with that we've seen that the trender has changed its color and has given a positive indication. For further confirmation, we are looking at another parameter as well, which is the 50-day moving average. It's a short-term moving average. It tries to smoothen out the impact for any price moves in the short term, and it indicates how the movement could be in the near term. Two times in the last 1 year, when we've seen the stock cross above the 50-day moving average, it has managed to rally as much as 10%, once being somewhere in the month of November, early November, and once in the month of July. It went up from the levels of as high from about 425 to as high as 500 as well. So watch out when it comes to Kansai Nerolac.
All right. How well has this worked in the past?
So this is particularly for the trender indicator, and this in the past has managed to give fantastic results, more than 5% over the next 1 month after the trender indicator flips its color to green.
All right. Thanks a lot for that, Yash. That's Kansai Nerolac there. But for a deeper insight on Indian equities, visit BloombergQuint.com, where we identify technical triggers that have emerged in a specific stock or a sector every single day. On today's Bloomberg Edge, we feature Bata and what will its put call ratio and volatility charts indicate. That's a BQ Blue exclusive. 42 seconds left to go for market pre-open. SGX Nifty, a very sharp cut coming in there. So you are going to expect a slightly more volatile open and a knee-jerk reaction to the news flow that we have been referring to since morning. currency and the bond market yields are also equally important in today's setup and how they open up for trade. You are going to be expecting a sharp depreciation coming in on the rupee, but that's what the SGX is, 10,800. Still down heavily, closer to about 83 odd points on the SGX Nifty, while the rest of Asia seems pretty flat or marginally negative. Pre-open ticks on your screen. Not much that's happening at this point, but we are showing you a flattish bias on the Nifty 50. So that's one thing to watch out for, but we'll wait for these prices to consolidate. Individual stocks is what's going to garner attention. We'll come back to the Nifty. Advani Ports recovery. The stock was down 9% yesterday, at least in pre-open. The first ticks show Advani Ports up about 3.5%. BPCL moves up. Remember, we spoke about how crude oil prices have come off in overnight trade, and most of the oil marketing companies, key beneficiaries, are up in trade. So BPCL is up 2.6%, and the rest of the pack as well follows suit. HPCL, remember, moves out of the index by the end of March. Replacing it is going to be Britannia, so you're going to keep a close eye on that one. As 228. Bajaj Auto is up 1/3%. Wipro is up 2%. That's Asian Paints, which is up 1/4. TCS, Tech Mahindra. Remember, yesterday as a pocket, IT was the one that led from the front, and today's session is no different because you've got most of the big weeks up in pre-open. Losers, Hindalco is down 1.5%, Indiabulls Housing is down 1.3%, Z is down 1%, Bajaj Finance, JSW Steel, Reliance Industries down 1% in trade. No major reaction on the index in pre-open. For the currency, yes, 0.5% appreciation is what you've got in early morning trade from a close of 70.98 yesterday. It's at 71.3 right now. For the bond market yields, the close was about 7.41. No major change out there as well. So the digestion seems to be well placed right now.
Yeah, well, no official confirmation as yet, right? We do not have any official confirmations. I think that's what you got to go with. Yes, the sources have told various news wires and other agencies about this having happened, but we do not have any official confirmation as yet. So playing it by the ear, playing it by what the NDF markets were suggesting as well, 71.28 on the currency. I think that remains a very key important monitorable. We should try and get more voices on that as well. But keep that in mind. Yes, there's a sharp fall in the rupee, but this is a knee-jerk reaction on the currency that we saw in the SGX Nifty as well. And we might see in the Nifty too. The question mark only is, can there be a sustained reaction to this or no? That is the key thing. And that, to my mind, will depend on what's the kind of confirmation or what's the kind of news flow that comes in from any of the government authorities, whether it's the Indian Air Force or the military or the government coming out and giving out any kind of official confirmation. Till now, it's all source-based.
The Indian government.
Yes, the Indian government. Yes, let me rephrase myself. Thanks. Yeah, so Indian government, because that's what we need to wait for before even taking any big reactions. But yeah, Devina's right. For now, just about 0.5%. Let's wait and watch what happens to this during the course of the day. If Gaurav Bissa will be joining us in moments from now, we'll talk into him as well. Okay, Gaurav Bissa is with us. Gaurav, what's the kind of trade that you would take in a scenario like this? Part two of my question would be, while it's very close to expiry for the next series or otherwise, would you make use of options in such volatile times?
Good morning. If you look at the option data or the F&O data till yesterday, things were quite fine. 11,000, as it has been acting as strong support, would be acting as strong support. 10,800 was the immediate hurdle, and we have crossed it with relative ease. A lot of writing was seen, 10,700, 800 put options. So in all likelihood, if 10,800 is sustained, then we can again head back towards 10,900 by end of day today, or maybe by tomorrow we should be again heading towards the level of 10,900. Overall, Nifty is going to be in the range of 10,750, 10,950. A lot of writing is seen in 11,000 call option. That has been the case for last few months. And 10,750, 800 is the level where we are seeing a lot of writing happening in the put side as well. So for me, it is going to be range bound one. I would not play for a very large up move unless we don't see a close above 11,000 comfortably. So for me, it's a range bound mode. And whenever there's a doubt and whenever there's a strong supports and resistance approaching the markets, it's always best to write options. For me, the strategy would be to sell a 10,900 call and put combined straddle if we again see a Nifty bouncing towards the level of 10,850, 860 on the spot side. Because I expect Nifty to be more or less still expiry in the range of 11,000 on the higher end and 10,750 on the lower end.
All right, just stay on with us, gentlemen. Vivek Rajpal, Asia rate strategist at Nomura, Singapore, is joining us on the phone line. Vivek, thanks very much for taking out the time and speaking with us. The reaction to the currency right now, a lot of news flow around, and you maintain the knee-jerk reaction to about 71.3 odd for the rupee. No major move in the bond market yet, but what's it looking like? What are you anticipating in terms of the volatility for the currency?
Well, yes, I mean, there is a geopolitical uncertainty, but I mean, the news flow until now is suggestive of the uncertainty, but I think it's more of a controlled reaction until now. We have to see how further this geopolitical uncertainty goes. But the way things are developing, it looks like whatever the news flow is suggestive that that markets may still remain well behaved. Nevertheless, volatility will continue, but it may not still be a trend volatility kind of a situation. So let's see. Fingers crossed here.
According to you, what is the currency, the fair value of the currency at this point? While we are trading around that 71.5 mark, what would the fair value be?
So fair value is it depends on various factors. The way oil behaves, for example, or the way real rates in India emerges out. But at this juncture, I would think something like we are probably in the middle of a range with something like a 71, 72.5, that kind of a range for the time being, and then we have to see how this geopolitical uncertainty plays out, as well as how the global EM performs.
Vivek, just one question from my end. Good morning and thanks for taking the call. If indeed the action and the reaction is contained to what's happened today, would you believe the action in the currency and the bond markets would also be contained to the knee-jerk that we've seen thus far?
Absolutely. I think you have summarized it absolutely. We have to see whether the action and the reaction remain contained or not. Until now, it looks like a contained situation, which effectively means that the volatility, though has clearly risen from last week or so, and probably will stay elevated, it will still be well contained. I think key is whether there is a further escalation in tensions or not. If there is no further escalation in tensions, then I think market will take it in its stride.
If there is?
If there are no further escalation.
No, but if there is further escalation, then?
If there is further escalation, then we have to take a
call depending on the news flow. Okay.
Yeah.
Okay.
Yeah.
Cool.
So a lot is dependent on the news flow.
Cool. I was just trying to get a sense of whether you have any downside estimates to the currency if indeed the news flow escalates. But we'll probably play it by the year. Thanks a lot for that, Vivek. Thanks for joining in today and giving us your thoughts. Appreciate your time.
Thank you.
Okay. I'm guessing that's probably the right call to make as well. You can't really go out and predict that if this were to happen, then the currency will slip down to X, Y, or Z. For now, contained, but I must say at the end of 8 minutes, Devina, the Nifty is showing a downtick of about 100 odd points. So that's playing in line with what the SGX Nifty was indicating. Let's wait and watch if there's further damage to this or not. 10,775 at the end of the pre-open session, and the Bank Nifty 2 down about 300 odd points in the pre-open session. 26,853. That's the other big monitorable, isn't it, Amit Harchekar? You were more sanguine on the Nifty, but if the Bank Nifty starts off 300 points lower, would you trade the Nifty Bank?
Well, again, I would be quite bullish on Bank Nifty, because if you see from a positional perspective, 26,500 to 26,700 is a strong base for Bank Nifty. And overall, the structure, if you see Nifty Private Bank Index chart, that clearly tells you it's forming a symmetrical triangle. So the upside potential stands at around 28,200 to 500 on the Bank Nifty. So we are quite positive. Despite a lower opening, we would be buyer on this market. We don't expect markets are into a trend reversal zone, because most importantly, if you see the Nifty equal weighted index, where almost equal weight is assigned to all the stocks that has already formed a triple bottom formation. And whenever such structure happens for a period of more than 2 months, you see a strong base formation, and generally market moves up by at least 5 to 6% before we see a major reversal. So quite positive on markets, despite even if Nifty move opens 100 points lower.
All right, one stock, barring one stock, 49 stocks on the index trade with losses. And that's the reaction that you're getting on the Nifty 50. Your worst performer is JSW Steel, which is down 3%, followed by Yes Bank, profit taking on that counter. BPCL remains unchanged, which is just one stock in the green, and that too absolutely flat. You wouldn't call those gains, even for a Bharti Infratel.
Yeah.
Hindalco, Reliance Industries is down 2%, so a big heavy weight like Reliance really weighing down on the index in a big way.
Yeah, Devina, the other bit is if you look at the pre-open on the Nifty 500 and the gainers list, there are two names which are up over 1%. After that, the third best performer on the Nifty 500 in the pre-open session is Z-Learn, which is up just about 1/3%. It shows the kind of sentiment that exists, at least, and let's see if it worsens. This is the third best performer, by the way, and look at the quantum of gains. Otherwise, almost all the other stocks are flattish to just marginally higher in trade. So the breadth might be a bit of question today as well. But we'll get to know about it in 5 minutes from now. Minute 7 from Market Open. Let's tell you all that you need to know to stay ahead in trade today. First up, Britannia will replace HPCL on the Nifty 50 index from March 29th. We told you so in a story on February 20th.
ICRA downgrades Diwan Housing Finance commercial paper worth 8,000 crore rupees. DHFL says ICRA's downgrade is not based on merit.
Manufacturing operations resume in Eicher Motors' Chennai facility. The estimated impact of the strike to production was 3,200 motorcycles.
Raksha Valia, who is enlisted as Sun Pharma promoter, released pledged shares of 1.17 crores, over 1/3 of the encumbered stake in the company.
And in key brokerage calls, Credit Suisse maintains underperformed rating on IIFL Holdings, cut target price to 315 from 400. Says the wealth management yields could be volatile with changing revenue model.
All right, Mayuresh, quickly, what are you going to be watching out for in terms of individual pockets this morning, or even individual stocks?
No, Devina, so I think keeping my eye out on financials, you're probably keeping my eye out on select NBFCs as well, because that's the maximum stress that the markets have probably observed at this point of time. And very, very selective on the consumption basket. So within consumption, again, a few of the paper stocks, hotel stocks is something that I've been monitoring for a length of time. Gold finance companies, as I have said, and select cement stroke infra names.
Okay. Mayuresh, we'll leave it at that. Thanks so much for taking the time out and being with us today and giving us the thoughts. Really appreciate your time. Well, watch out for some of these individual movers in trade as well. Let's get in one more fundamental voice on the show. Can we get in Pashupati Advani? He's founder at Global Foray, joins us right now. Pashupati, good having you. Thanks much for joining in. Volatile situation, no official confirmation from the government side as well. But you reckon this sentiment reaction could deepen?
Well, obviously, I don't think war is something that we want to go into right now.
We don't know if it's happening as yet or not.
Yeah.
And if it is a war or just restricted to a strike.
Well, you know, strikes means counter strikes. So let's see what happens. Okay. I mean, you know, obviously, I don't think our country is ready for a war right now. But there are obviously people in Delhi who are extremely upset about what happened. And all over the country, I would say, was extremely unhappy. So if it is a war, it's probably, I mean, if it is a strike, it's probably a good thing. If it turns into a war, I think it'll get quite messy.
From a market standpoint, Pashupati, right now, what should the focus be on?
Well, you know, markets are obviously going to go off because of it, because foreign investment will take a seat back. You know, people's mindset will change. So I think, you know, what the market's showing is that there is some rumor, but it's not. It may be fake news. Obviously, if it was a war, I think it would be a lot lower.
Okay. For now, as we said, no official confirmation. I think me and Devina have been talking about it all through the morning. Let's wait and watch what happens. We'll continue the conversation with Pashupati Advani as well. But just a minute left for the markets to kickstart trade. Let's get in top trading calls from our experts. Gaurav, Bissa, I'll come to you first. One stock that you would look to trade today.
Federal Bank, we have seen a strong correction already in the name. It's bounced back strongly from levels of 70 and 80, rounding bottom on daily charts. One can wait for 25 levels in status of 7.
All right. Amit, Harchekar, what about your top call?
I would be buying Axis Bank on a decline. The stop loss would be around 680 and expect a target of around 725.
Okay. Amit, we'll leave it on that note. Amit, thanks so much for taking the time out and being with us today and giving us your thoughts. Gaurav, Bissa, if you can hold on, we'll just take in your opening thoughts post-market open from you. But 18 seconds left for the markets to kick-start trade. The question mark only is that do we contain ourselves to that 1% downtick, or do we extend those losses that we've seen in the pre-open session, if not in the early morning trade, then during the course of the day? And I think we'll get in enough expert voices during the course of the show as well to talk about that. Pashupati are already with us. Gaurav Bissa staying on the pre-open lines, about 1% lower. Let's see if this deepens. The broader markets and the breadth in the pre-open session was looking wobbly. At least the gainers were looking very, very wobbly, and it's showing in the way the mid-cap index has already reacted about 1.5% already. These tend to be more volatile, so let's wait and watch what happens during the course of the morning to both the mid-cap and the small-cap indices. For now, as per script, as Devina was saying, hardly any gainers. We don't have gainers. Maybe the IT pack, select FMCG names might be lesser impacted today. I think that's what you got to look at least as far as the sentiment goes. What about the losers? Some financials down, some metal names looking slightly soft. Advani Port continues from where it left off yesterday. So down 9% yesterday and down another couple of percentage points in the session today. But it's essentially a tick of red, and this is sentiment more important, more than anything else. It's the sentiment around the markets. As we speak, it's just about 0.75%. So there is no exaggerated initial movement on the index, but a fair degree of red, with just about 0.7% for the Sensex, 0.68% for the Nifty. Very measured, very tempered right now, but this is just the first 1 minute. Let's see if there is more reaction that we see during the course of the day. The Nifty Bank, which was up about 1%, is down about 200 odd points. But Devina, the index shows the nervousness, a clutch of losers, no big reactions, but almost seems like bracing itself for impact should any of the impact come about. But just about 0.6%, not a big gash.
Not a big gash, but your broader market always tends to amplify whatever the index does. So you've got the mid cap and the small cap index losing over 1%. I want to talk about specific stocks. So the big one, Britannia, coming into the index on 29th March, and what the stock has done this morning. So it's already in the last 5-6 days has run up about 5 or 6%. So you've seen the initial run up. The stock's not doing much right now. Divan Housing Finance on the ICRA downgrade, it's down about 5% right now. JVK Power and Infra down 6.5%. Remember, a tally of about 45 to 48% increase in a matter of 3 trading sessions. Some profit taking on that one, down about 5%. Bumpers and Beverages is down 5% as well. And it looks like today's session sees a little bit of a break for the sugar pocket in their upward strides. So Ramamurthy down 2%, then you've got Bajaj Hindustan down 3.5%, Dhampur Sugar is down, Dwarikesh is down about 3%. So the entire pocket looking slightly weak today, but no big cuts as such. Reliance Naval is down as well. You've got Prestigious States down 3.5%. Remember yesterday's session already, when the GST news came out, these stocks in yesterday's session saw an initial reaction, but then they closed lower in trade. And today's session is a follow-through of that, and you're seeing real estate as well look weaker in early morning trade. And that's what you've got in terms of your bigger losers. Far and few in terms of gains, but you do have a few of them. So a counter like Swan Energy, remember this is a name that came up yesterday as well, 20% higher in yesterday's session, and this one today as well looks higher by about 4.5%. And the other pockets to look at are Persistent System, that's 1.6% higher. Max India moves up 1%. Fortis Healthcare moves up about 1%. And then you've got a Godfrey Phillips down up about 0.5%. Bajaj Finserv up 0.5%. That's on the index though. But no big quantum moves coming in on any of these names. 1,057 stocks decline versus 162 stocks on the NSE, which are advancing. Some opening comments, Gaurav Bissa.
Well, if you look at Nifty, it's seen a decent recovery. I would not be too aggressive at these levels, for the reason that let a 15-minute candle at least form, a 15-minute or half an hour candle. If we are still trading about 10,800, then one can at least play with a 10,900 call option for the current month, and we can expect a Nifty bouncing back towards the level of 10,880, 10,900. And if at all we are trading below 10,790, 780, even after half hour candle is formed, then we can look at some more downside can be possible. For now, things are not looking as gloomy as what they were looking on the pre-open time. But yes, if 10,800 is conquered, then we can see a decent upside today itself.
Okay, we leave it at that. Gaurav Bissa, thanks so very much for joining and appreciate you taking out the time this morning. That's Gaurav Bissa there with his views. So, Pashupati, just coming back to the outlook for 2019, most brokerages pegged a target of about 11,000, 11,300, not a major breakthrough from what we're already trading at, with slightly subdued earnings and the already stretched valuations that we're trading at. Do things change materially now? How are the dynamics going to play out if you add the geopolitical tension to the already uncertain basket of elections and other global tensions that are weighing down?
See, I think the reason why most brokerages are saying 11,000 is because the uncertainty for the first half of the year. Plus, of course, the geopolitical is sort of today's spin. But basically, I think we've got no political direction that we can see till at least May, till the elections are out and till the counting starts. So that means half the year is washed out. However, I am seeing some capex by India Inc. So I think that is a positive sign. So, in particular industries, there is capex happening, which is good. And there's also a lot of cleanup, particularly in promoters. This government has gone after a lot of erring promoters and is making NCLT work. And also, they're also, catching everyone, making everyone straight. Unfortunately, they've had to give in on GST in a couple of places, and now they've just given up in real estate. So let's see what happens, because those things kind of open up the floodgates of inefficiencies. By having 5% with no input tax credit, it brings cash back in the system, which is kind of counterproductive.
Yeah, I think that's a point that somebody else was making a real estate expert was making in yesterday's session as well. Pashupati, based on whatever you've seen thus far, one in terms of the rate changes on GST and then the Q3 season as it's shaped up thus far, do you get convinced to go out and buy into some ideas lock, stock, barrel right now, or would you believe that none of the better performing stocks also would be in a hurry to go up in a situation like this, wherein we're besieged by news flows, trade wars, the India-Pakistan situation, and elections looming in a couple of months?
Well, and also you've left out the fourth most important thing, which is the weakness in the dollar. Weakness in the rupee. Versus the dollar. So I think that's another factor. The reason why we saw TCS in blue today is because, in green today is because, obviously any kind of war event is going to be weak for the rupee, and that means good for the IT companies. So, that's what you're seeing. I am concerned because a lot of investors from outside are sitting on the sidelines and they're saying, don't call us, we'll call you sort of mid-year and see what's going on. And as a result of which, our market is probably one of the worst performing markets in dollar terms, except for, Venezuela, which you can't count. But, certainly compared to the rest of the pack, has not done very well. The other thing is that if China and US do make a deal, and I actually feel they will make one, because people who are in the business space behind Trump are saying, you cannot just behave like this. So because of that, if they do make a deal, that's also going to be bad for us, because it means new investment will go back into China. China is a little ahead of itself because they're all buying up, the locals are buying up stocks like crazy.
You talk about business investment or FII institutional?
Both. Because again, China is also following our model. They've got this FPI type setup and registration. So they're a little behind us in that curve. But the investors that are coming in are obviously coming in with deeper checks, because the market is obviously a lot bigger. So I am seeing that money will start going back there if a deal actually goes through. And I think that's imminent in the next couple of weeks.
An interesting note there, last July it was the reverse. It was India outperforming the rest of the emerging market basket, and now a complete switch of that, with China looking to enter the bull market once again from the lows of December that it's seen, and India doing absolutely nothing. It's just been in that range-bound trade. So we'll have to wait and watch as to how this plays out. But like Neeraj highlighted, the better placed names, better placed companies and stocks right now. are they going to be the center of focus, more investment likely to pile up there, or that's still because of the environment being so uncertain, you'd rather sit on cash?
See, there are two segments. One is the retail segment, which I think depends on leverage to a lot of extent, and that leverage is getting squeezed by NBFCs not having money. So I think that is one issue. All of a sudden there are no more phone calls asking to lend you money on the phone. So that's a good thing, because the NBFCs that are offering the money are not having the funds to do it. So that's one side. The foreign investors again are just literally they're sitting on the sidelines saying that why should we come in here? It was already rich. Earnings are not playing out the way we expect them to play out, and let's just wait. And the dollar's getting weaker. I mean, the rupee is getting weaker compared to the dollar. So therefore, it doesn't. If we do nothing and the market does nothing, we'll be able to buy it, 2-3%, 5% cheaper by just sitting on our hands. So I'm seeing a lot of that, a lot of disinterest, which is not good for our markets.
Is that temporary disinterest, waiting till the election results are out?
I think so. Because I think that if we have a conclusive government, whether it's one way or the other, that'll be great. The prognosis says that it's going to be a BJP government with some coalition partners. The question is how many seats are they going to get? And obviously everyone's looking anxiously at UP, and at the same time looking at what UP has been able to do in the Kumbh Mela. And saying that should we vote for the incumbent BJP government or not? And that's the big question, because they got 73 seats in UP last time. And the prognosis now is anything from 25 to 50. Obviously 50 they'll be grateful for, 25 will be a mess. So I mean that's where it is, and most pollsters are saying 35, 40, 45, which is a big down from 73.
So how do you capitalize on this period while we're talking about uncertainty till elections are out of the way? This window is there. You do have these months at hand. So do you sit back and say, okay, I'll put my money in defensives, make that marginal return that they've been giving me, and I'll take my riskier bets once the results are out?
Well, that too, but I think that also, one can start looking at fundamental investing and looking at high dividend yield stocks, for example, which has been the game for the last few years in US. So you've got some PSUs are in that space also, but there are those are worth looking at.
Yeah, we looked at that, Pashupati. It's dominated by PSUs. Do you want to get into that field? I mean, ONGC is high dividend yield stock, and it's corrected quite vehemently. Would you want to play that?
Well, the only thing is that if we're going into election code in the next week or so, it looks like. So the point is that you cannot do any more tinkering, at least till after the elections. So in that sense, and this is dividend season, if you know what I mean. They're all going to pay out before 31st March, some of them, and some of them will start paying out early. So let's see what happens. They've got budgets to balance, so I expect some dividend flurry, definitely in the month of March from PSUs.
Did you log into something?
Sorry?
Did you log into something?
No, I have some. I'm long and wrong some, but that's okay. That's part of the game. But at least you hang on to a good PSU stock which gives you 5%, 6% yield. That's actually better than being in the bank, I think, at this point.
How would you, what would your approach be while you've spoken about non-banking finance companies, pure play banks? Your private sector banks versus your public sector banks?
I honestly don't think the situation is over yet. And just by saying, for Z, we're not going to call in the shares, or for ILFS, it's not an NPA. I mean, that doesn't really make it go away.
That doesn't remove the stress from the book.
But that doesn't make it go away. Yeah, sure, you're able to not report. But I mean, that's obviously a potential advantage to your balance sheet. But the reality is these problems are not going away. And, they're going to take time to get sorted. So I think that time may be even 2-3 years. It's not going to be like overnight. And so the exuberance that one should have for NBFCs should be a little tempered, because I think a lot of them are having structural issues. And government has shut down a lot of the smaller ones, so that's also not helping, because there were a lot of smaller ones. Though you may call them unofficial, though you may call them unregulated, 95% of them were actually performing a service. So, who knows?
Anything else that you are particularly watching out very closely for probably turning the cornerstone in some fashion? Or
I actually was looking at positioning. I would say taking event risk and positioning for elections, like in particular states, if companies are going, if particular parties are going to do well, the companies that are aligned to those parties that maybe anti-incumbency will make money. So that's one space. And again, I'm looking at companies that are actually spending on capex to see what the cycle will be. It'll be a longer cycle, but at least they have faith in their businesses and they have faith in growth. and the numbers are already showing. So those are the ones to basically look at and invest in. I mean, obviously you don't want a company that's doing capex for the promoter to suck out the money. But if it's genuine capex, then those are the companies you want to invest in because they can see the orders, they can see the growth. And maybe it's a packaging company that's depending on Amazon, but Amazon's here to stay. But whatever, there are those kinds of themes that we have to look for. And search and destroy, as they say.
The other point being is, while this is the way to look at investing right now, how would you approach just looking at earnings for companies, or probably supporting that with companies that are good return on capital employed companies?
I think the latter. I think return on capital employed. And I think also you've got to look at, first of all, companies that are doing well and then see if they've got good managements. And if they've got good managements, then they're worth the first sift. And then you have to look at industries that you believe in. I've been a believer in cement because I think that, work is still going on. Prices seem to be going off, so they're getting hurt. But I think that that's temporary because I think that people do see the roads and see the improvement. People do need the houses completed. So, I think that cement companies will continue to grow. And I think there's an arbitrage between mid-cap cement and large cement. And the large ones are just continuing to swallow the smaller ones. So weak management, mid-cap cements are probably a good place to look.
Oh, interesting. Because you would believe that there would be a potential acquisition candidate.
Because, I mean, the multiple is there. So even if they trade in for stock, I mean, they're going to make a lot of money. Or they're, part cash, part stock. And you've got 2 or 3 large players still looking aggressively. So I think that they're there. And,
okay, interesting. Pashupati, my final question to you. Any options that you do? I mean, you had once told us 2-3 years back about some very interesting things that you do in the market. Anything that you're doing right now?
No, I think that, this is the time where, there's people saying be positive, there's people saying being negative. So actually there's a great opportunity in just writing, options in both directions. One would be a little caught out, and if this thing turns into a war, one will get hurt. But I think that otherwise, you're in this range. I think you're between, 10.5 and 11. And so, I think that, and you're right in the middle of it right now. So, I don't, every time you get up to 10,911, you had your technical analyst saying, look at it. And then nobody talks about below 10,500. So, we're in a range. So you might as well eat the premiums for as long as you can.
All right. It was great chatting with you, Pashupati. Thank you so very much for joining us this morning with your thoughts. Nifty for itself, holding on to those losses of about 0.75%. No major reaction, but as we say, tempered. 10,800 is still being held on to. Sensex is down to 66 points. Banks losing a little bit more. We're going to take a very short break, but on the other side of the break, we will speak to Chalet Hotels' Sanjay Sethi about plans underway post-IPO and discuss business outlook for United Breweries with Managing Director Shekhar Ramamurthy. That's coming up after the break.
Fulfill your dreams of buying a new house, new car, or achieving academic success. Attractive interest rates and easy processing. The trust, commitment, and excellence since 1937. Indian Overseas Bank, good people to grow with.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
You're watching Indian Open. India's hospitality sector has been going through a lot of change of late, be it new hotel additions or the rise of bread and breakfast formats or homestays. So much so that the country's largest hotelier, the Taj Group, has entered into the homestay segment. Chalet Hotels, on the other hand, is one of the more premium properties like the Marriott. What's supportive is the recent rise in tariff. So will this trend hold on? Let's ask Sanjay Sethi. He's the MD and CEO of Chalet Hotels. Sanjay, thanks very much for taking out the time. Let's talk a little bit more about that, and in terms of how the increase in tariffs have actually supported the industry.
Well, good morning firstly, and congratulations to all countrymen for the strike that the Indian Air Force has done this morning. It's a proud moment for us that we are getting back at them. To come back to the business itself, Chalet, as you know, listed the company. We listed the company a couple of weeks back now, and we've done with that process. We are now back focusing on our business, and our business strategy is very clear. It's a four-pronged strategy. One is to drive performance of the existing assets by sweating the assets through an active asset management model. Second is to develop the greenfield pipeline that we have today, which is a healthy greenfield pipeline. Third strategy for us is to look at growth through acquisition opportunities of ready or near ready hotels, and on that front we are looking for opportunities to acquire hotels in the key cities that we'd like to be in. And finally, to make sure that we prudently deploy the capital to create shareholder value. So that's the strategy as far as we are concerned. Not much has happened since, it's not been so much time since the IPO and now. So nothing new to report except the fact that the industry trends are extremely positive, and I think we've seen very healthy growth across India for January and February.
Just talk about these new formats and how they are likely to impact the regular business. You have your bed and breakfast, you have your homestays now, which are gaining popularity. How does it all play out for a hotel chain like yours?
Well, all forms of alternate accommodation is competition in some form or the other. So therefore, we do not ignore anything that comes into the market. Having said that, because we are positioned at the top end, the top tier of the segments of the industry, we are a lot more insulated than the budget and the mid-segment hotels. But as I said, we look at them carefully. I also believe that whilst there are a lot of budget hotel chains and brands that have come in play, the aggregator model is closer to the online travel agent model than actually a hotel operator model. Because the ability to switch off inventory to the aggregator is pretty swift. And therefore, we believe that the brick and mortar business is still going to be the strongest player as far as the hospitality industry is concerned. We are the people who provide the raw material inventory to the online travel agents and the aggregators. We will continue to hold that position of a prime position.
But are these a bigger threat to you, or they cater to different segments of customers, which probably you may not be catering to?
I'm sorry, the audio is not too clear, so I can't hear you clearly. It's a little muffled.
I was
Could you repeat the question, please?
I was asking you with these new formats coming in, are they direct competition for you, or this is not a segment that you any which ways cater to?
No, we don't. So that's what I said. You know, we are insulated at the segment that we operate in. We being at the top tier segment, there's a huge gap between where the aggregators and the budget hotel chains are operating at. Also, you've got to keep in mind that our hotel primarily in the deep markets of tier 1 business cities, and a little over 50% of our business actually comes from foreign travelers. They need the comfort of global brands for various reasons: safety, security, quality, hygiene, all of that put together. And I think from that perspective, Chalet is completely insulated from the risk of aggregators and bed and breakfast places.
What is the average occupancy right now, and is it expected to increase?
So I cannot give you the immediate occupancy because we haven't gone down to the market and shared that as yet, but we are operating at roughly around a 74% occupancy as we speak. For H1, we were at 74%, and that's been growing year on year, quarter on quarter for us. Rates have also started growing in the last few quarters, and we see a positive trend on the RevPAR, which is revenue per available room. And we're very confident of getting healthy growths on the top line, which will result in healthier growths on the EBITDA numbers.
While you said that there's nothing much that has changed since IPO, what are the bigger plans for the upcoming year in terms of expansion, increasing the number of keys, number of properties?
So, look, our greenfield pipeline today is 3 hotels, which roughly adds up to a little under 600 rooms. In addition to that, co-located where we have our hotels, we've got 2 office towers coming up, adding up to 1.1 million square foot. This itself is a strong enough pipeline. We expect to complete all of this by FY22. Some of it will come in a little earlier, and all of this will be value accretive to the performance of the company. In addition to that, what we're really excited about is the fact that the organic growth out of the existing assets is very healthy. And that's likely to continue because, as you probably know, the industry is going through an upcycle. It's likely to be a longish upcycle, driven by the favorable arbitrage that demand has over supply or new supply of hotel rooms. Because we're a brick and mortar business, it takes time for hotels to get built. We're pretty confident that we've got a longish upcycle of about anywhere between 5 to 7 years ahead of us.
Just to get in a sense from you, while obviously the December-January period is a high tourist period, and you would have seen Q3 play out slightly more stronger than the other quarters, but you're almost past a few days of Q4 as well. What's the sense that you're getting in terms of pickup, and how would it likely pan out for you?
So look, if we look at our H1 numbers, we had almost double-digit growths on the EBITDA numbers. That was H1. Unfortunately, we haven't gone out to the market with Q3 and Q3 numbers, so I cannot give you, speak about it right now. And I certainly can't give forward-looking statement for Q4. But what I'd like to say is that the growth pattern for Q4 has been in line with the growth pattern that we've seen in the previous quarters, and we expect this to be a healthy quarter.
This is a comparison.
Unfortunately, I can't share numbers on that.
No, from an industry perspective, I'm sure you can't share numbers, but from an industry perspective, how would H2 vary from H1 in terms of these?
So what happens is typically in our business, H2 is always better than H1 because we get a lot of foreign traffic flow that happens between October and March. In addition to that, a lot of the business events and MICE events in the cities happen during this period. So that will continue to happen as a trend. H2 will always overperform H1. That's one. Second is on the supply side, leaving aside maybe 1 or 2 cities, we haven't seen any significant growth on new inventory of hotels, which is good because the demand's growing. And if I was to talk about the supply side growth, for example, Mumbai, which is the deepest market for us, 2/3 of our portfolio lies in Mumbai, is expected to grow from 2018 to 2022 from roughly around 12.7 thousand rooms to only 17.5 thousand rooms in the branded space. Now, over a 4-year period, that's a very muted growth in supply. With the demand growing at a very healthy pace and outpacing supply, we expect occupancies to continue to rise and also give an impetus to growth in the rate side.
Sanjay, good morning. Neeraj here. Just one question. You've answered stuff about Chalet. I'm just trying to think of how do you see the industry shaping up over the course of the next 5 years? I know typically it's a very boring question, but the reason I ask this is because a couple of your peers have done some interesting things. Lemon Tree, they've done that with that KKR, that JV, to do that co-living platform. We hear about Taj getting into the homestay kind of a model as well. Do you see the revenue mix and the business model of pure play hotel companies changing from being or remaining only pure play hotels to doing a lot of other allied activities as well in the living space?
So look, whilst we are not doing allied activities in the living space, we are doing activities within our portfolio on the real estate space. The thought being the following, that if you're building a hotel on a parcel of land, you're going to build as many rooms as the market can sustain. We already have the largest hotels in each of the markets that we operate in. For example, JW Marriott Sahar or the Bangalore Whitefield Marriott are the largest hotels in those cities. Now, we had a lot of land parcels there, so we didn't just stick to hotels, and we didn't kill the market by oversupplying the market with new inventory. So in addition to the 585 rooms over here at Sahar, we've got a retail area of about 125,000 square feet. In addition to that, we've got a business center and office area of almost about 400,000 square feet. That combined together gives us an integrated complex which becomes complementary to each other. So yes, we are looking at sweating the assets by using alternate forms of real estate. Similarly, in Bangalore, we've got a mall that operates there, which becomes a great driver for clients to stay longer with us because there's entertainment, there's food and beverage, all of those options there. In addition to that, we've built an office tower, which is already operating. We're building a second one there now, which becomes a demand generator for the hotel itself. So as I said, all these assets are complementary to each other and feed business to each other. Speaking about the other forms of business like Lemon Tree or Taj have explored, we haven't looked in too deep into that to understand how the business model works. We are largely a hotel owning company. We have some non-hotel assets. We believe the highest amount of returns come when you look at pure asset play as against a hybrid operating and asset play. And I think it's worked for us all these years. We don't see any reason why we will not continue to grow this more aggressively from here onwards.
All right. Sanjay, thanks very much for joining in. Really appreciate you coming on the platform and sharing your industry growth prospects and the overall business model and the likely sustainability of that. Thank you so very much. That's the management at Chalet Hotels with us this morning.
Well, moving on, sticking to kind of consumption. India's beer consumption, per capita beer consumption, is the lowest in Asia. Remember the chart of the day that we did, wherein it showed that it was lower than Nepal as well. Does it indicate potential for growth, or does it underline the bitter regulatory and pricing scenario that beer makers have to gulp down in India? Fear of higher state taxes, alcohol ban has become a standard risk too. But hey, United Breweries hold tight to its lion's share of the market. Volumes growing nearly 16% in Q3. Margins growing with the scale. Let's talk about all of this and more with Managing Director Shekhar Ramamurthy. He joins us right now on the show. Shekhar, good morning. Thanks so much for joining in. Neeraj here. I have one question for you. How did you do it? It was a fabulous Q3. All that went right in Q3, do you see that continuing in the quarters ahead as well?
Thank you very much for your compliments and kind words. And as you said, India is a very challenging market for beer. And indeed, our per capita beer consumption is extremely low. Now, of course, you can look at it both ways, whether the glass is half full or half empty. And as people in this business and as market leaders in this business, we'd like to look at it as half full because clearly the potential for growth is there. We have large population, we have large number of young people, we have economic growth, the social mores are changing, and all that is positive. However, on the other side, what holds the industry back is that the tax levels are very high. The regulatory framework is very complicated. We are perhaps the only category or business category in this country of any significance that is not part of central subject, but a state subject. We are out of GST. Each of the states depends a lot for the revenues on alcohol, and they tend to tax beer a lot. So all those are the factors which keep the beer industry back. Left on its own, unfettered, it would definitely grow much faster. Now, as far as our own performance is concerned, what I'd like to state is one of the factors for this growth is that the base effect. That same time last year, the base was lower. You remember that over the last 2 years, we've had the highway ban, we've had the impact of GST, we've had the impact of significantly increased taxation in Maharashtra and in Bengal. So all said, the base was lower, and that clearly benefited us. Going forward, we do see growth, and I have been consistently saying this over the last few quarters, that we see the industry growing in mid to high single digits. I would say we see the industry growing at about 7 to 8% over the next couple of years. And we expect and we hope that our growth would be at least 2 points ahead of that. So we anticipate a growth of about 10% for UBL, about 7 to 8% for the industry.
Okay, your volume. Okay, so this volume growth of 16% and the street was working with a 14% number any which way, Shekhar. But this volume growth of 16%, are you saying that that's in part on account of a low base and normalization would see it cooling off to maybe 14, 13, 12 and eventually 10%?
Definitely. I mean, like I said, over the next 12 to 18 months, we see our growth to be at about 10%. It could be a little higher, it could be a little lower, about 10%. We see it to be ahead of the industry. One of the other drivers for our own growth, apart from the base effect, is that we have launched several new brands, and they're all doing well. We launched Kingfisher Storm about a year and a half ago. It's doing well. We launched Amstel recently, and it's beginning to show good results. Our Ultra and Heineken continue to grow in strong double digits. So our portfolio play is also giving us as the growth. Plus, of course, the base effect. And of course, that there is a rebound in the industry too. And you would have seen the same effect across FMCG. There is a consumption uptick, which is good overall for everybody.
Yeah, that's true. I think, and even in your industry, selectively companies did well. I think Carlsberg India business also showed some good numbers. Some of the smaller players also displayed growth. The question though I have, Shekhar, is I remember a very emphatic and confident statement from you in an interview with me about 3 quarters back, wherein you mentioned that when I asked you about your market share, and I know I bring this up every time, but you had mentioned that you will not lose market share. If anything, you will gain market share. Now, my question is, with this 16% odd volume growth, or with a slightly higher than industry average volume growth that you reckon you will clock in, would you keep on gaining some market share, or is it that the industry is expanding its footprint and you are maintaining your market share?
Well, Neeraj, the math on that is as long as we grow ahead of the industry growth, we add share. And our expectation is that last quarter industry would have grown around 12%, and against that we grew about 16%. So therefore, we've clearly added share. And going forward, our estimate is that the industry will grow 7 to 8%.
And you will grow 10%.
Yeah. Our plans are to 10%. So again, as long as we grow ahead of the industry,
you will gain market
we will keep
share.
adding share.
Yeah, my rephrased question would be then, because this will be simple math, yes, my rephrased question would be, would you be gaining market share at the expense of smaller fringe players, or is it happening without any conformity to the size or the scale or the geography of the player from where you're gaining the market share?
Well, there is not a simple answer to that, Neeraj, simply because, it's a complex state-by-state business. And there are some states where we are significantly adding share, some states where we are holding share. So in different parts of the country, the impact is different. But if you look at it overall, some of one or two big players are not able to add share, and some of the smaller players are not able to take advantage of the growth that the industry is providing. So it's a little complicated to give a simple answer to that question.
Okay. Seemingly, Shekhar, Uttar Pradesh is not a problem only for the political parties, but for beer companies as well. Not just in Q3, but I think the 9-month performance as well. You would admittedly believe that there is some issues out there in the market which maybe you or the industry is not able to tackle. What's happening there?
Well, the issues are quite simple, actually. From a UBL perspective, one of the things which happened last year was that the government changed the policy and dismantled the monopoly wholesale structure. Therefore, now we're dealing with a large number of wholesalers, which is always good for the industry. And that has resulted in industry growth. On the other side, the government has recently announced another duty hike. So prices will go up again come April. And from our side, United Breweries Limited, we have a capacity constraint in Uttar Pradesh. We don't have a brewery of our own. We operate through a contract brewing arrangement. And whilst we supplement our demand through bringing stock from other breweries in the vicinity in the country, we are not able to fully meet our demand. So Uttar Pradesh is a mixed bag. Yes, it's a politically complicated state. But from a beer perspective, it's a combination of regulation, which results in high taxes. But also there is demand, and just like the rest of the country, we are seeing an uptick in demand. And the challenge for UBL in the next couple of years is to gear up to meet the demand to enhance capacity.
Okay, so I'm just wondering, how would you be doing this? You're obviously not looking to set up new capacities. Are you active conversations with other contract manufacturers to up that?
Well, a little too early for me to comment on that, Neeraj.
Okay, fair.
Just rest assured that we are actively working on this, and hopefully we'll have something to share in the next 6 to 9 months.
Okay, I'll leave it at that. Okay, so last couple of questions. Now, Shekhar, I read in a report that glass prices have moved up. I also saw in your numbers that your gross margins expanded quite meaningfully in the quarter gone by. So how's the mix shaping up, and does this size and the uptick in volumes or market share give you scale and ability to expand margins even further from where they are right now?
Margins in our business are a combination of portfolio, state mix, etc. But what we've been able to do over the last couple of years also take a very strong look at our cost structure. And we've been able to take out quite a bit of non-value adding costs. That has helped our margins. As far as glass prices are concerned, indeed, the bottle prices have gone up by almost 25% in the last 4 months. So that's been a huge hit on our overall cost base. And so there's very little we can do about it, because the glass manufacturers have taken 2 to 3 price increases in the last 4 months. And in fact, even after that, there is shortage of new glass in India, and we are supplementing the new glass requirement through imports, which are even more expensive. So glass is a huge cost issue for us. But overall, we see that our strategic intent is to keep the margins at a healthy level through a combination of revenue enhancement, portfolio expansion, focus on profitable states, and overall look at our costs. Because while glass is going up, we have to find ways and means to control costs in other areas. And that's what we are planning to do.
You would maintain margins or expand them?
Our intent is to hold margins.
Hold margins. Okay. My final question, Shekhar. What's your response when you meet large institutional investors and when they ask you about the issues that a business like yours face when it's subject to so many whims and fancies of state governments, bans or timing issues, so on and so forth. How do you respond to them? How does a large institutional investor approach investing a large chunk in your company when the industry is faced with so many vulnerabilities, if I can use that term?
Oh, well, I will go back to what you said right in the beginning of this chat, where you very clearly and correctly mentioned that here is a country which has huge potential, but also huge regulatory roadblocks. So that's what I or my colleagues tell the investors too, that here is a country and here is a business which has huge potential. And of course, there are issues. And it's our job to try and maximize the potential and work within the constraints that are there. End of the day, our business is the business of building brands. Consumers like you, buy our brands because you want to. So it's our intent to continuously invest behind the brands, build scale, and work with the regulation, because every business has regulation. It's just that ours has a little bit more than others.
Well, you're doing a really good job of building that brand building and scale for sure. Shekhar, when you're in Bombay next, look forward to having you in our studios to have a face-to-face interaction as well. But pleasure talking to you today. Thank you so much for taking the time out.
Thank you so much.
Fairly confident Shekhar Ramamurthy of United Breweries will hold margins, will continue to expand volumes and thereby enhance the market share that they are sitting on right now. Well, let's wrap it up on this leg of Indian Open, slightly extended, but the situation demanded. So just keep in mind that the markets are now trading at the lowest point of the day. The Nifty is down about 1.25%. The Nifty Bank about 1.4%. So they've opened weak. They showed a marginal uptick, but right now trading at the lowest point of the day. All the action being taken forward on the FNO show. Thanks so much for watching this leg of Indian Open.